Silver is quietly setting up for a historic move. Silver isn't crashing and it isn't rallying either. But behind the scenes, something rare is forming. And when this setup appears, silver usually doesn't move quietly. Hey everyone, John here. Right now, silver feels quiet. Too quiet. No hype, no headlines, no urgency. And that's exactly why this moment matters. Because every major silver move in history started the same way, with boredom, doubt, and people looking the other direction. And while most investors chase noise, the real story is building silently underneath the surface. In this video, we're going to break down why silver feels dead, why that's usually the warning sign, and how gold's behavior is quietly setting the stage for silver's next big move. We'll look at the pressure building between physical demand and paper pricing, and the key levels that could decide what happens next. This isn't hype. This isn't a prediction. It's about understanding the setup before the crowd wakes up. So if you want clarity instead of noise and context instead of panic, you're in the right place. Let's get into it. Silver has just gone through one of its sharpest sell-offs in years, officially slipping into a bear market style move after an extreme fast decline. Such violent drops often shake out weak hands and reset positioning, but they also signal that volatility is far from over. For retail investors, this kind of sudden downside can be especially dangerous, particularly for those trading with leverage or without strict risk control. Even after the crash, silver remains highly unstable, with prices swinging aggressively as markets react to dollar strength, interest rate expectations, and broader risk sentiment. These whipsaw conditions mean the market can move sharply in either direction with very little warning. Retail traders who expect smooth rebounds or try to blindly buy the dip may find themselves caught on the wrong side of rapid reversals. Technically, silver is now hovering around critical support zones where either stabilization or another wave of selling could be triggered. A failure to hold these levels could unleash further automated and forced selling, while a hold could spark a sharp relief bounce. This uncertainty is exactly why silver's next move could catch many retail investors off guard, despite strong long-term bullish narratives. Why silver feels dead. Right now. Price stuck in a tight range, low retail excitement, media almost silent on silver. This is usually when big moves start forming. Right now, silver feels boring. No big rallies, no dramatic crashes, just sideways movement that's testing everyone's patience. For weeks, silver prices have been trapped in a tight range. Every small rally gets sold, and every dip gets quietly bought. That kind of price action doesn't excite traders. It exhausts them. Retail interest is fading, search trends are down, mainstream financial media barely mentions silver unless it's moving fast. And psychologically, this is important. Markets don't usually explode when everyone is excited. They explode when nobody is paying attention. This is what professionals call volatility compression. Price movement gets smaller, energy builds up, and pressure silently increases. It's the same setup we've seen before major silver moves in the past. Long periods of boredom followed by sudden aggressive breakouts. Most investors mistake this phase as weakness. In reality, it's often the market loading the spring. And here's the key point. Silver doesn't feel dead because nothing is happening. Silver feels dead because the move hasn't been released yet. The historical pattern nobody talks about. One of the biggest mistakes investors make with silver is assuming that nothing happening means nothing is coming. Silver has always moved in cycles, and those cycles all start the same way. First, consolidation. Silver can spend months, sometimes years, going nowhere. Price tightens, volatility disappears. Daily moves get smaller and smaller. This is the phase where traders lose interest. Media stops covering silver retail investors, give up and move on. But historically, this is the most important phase. Because after consolidation comes compression. Volatility doesn't vanish, it gets stored. Think of it like pulling back a slingshot. The longer it's pulled, the more violent the release. And we've seen this pattern again and again. Take the 2008-2011 cycle. After the financial crisis, silver moved sideways for a long time. It felt slow, it felt controlled. Then suddenly, silver exploded. From under $10, it surged nearly $50 in just a few years. That move didn't start with hype, it started with boredom. Or look at 2019 into 2020. Silver did almost nothing for months. Prices were tight, volatility was crushed. Then when macro pressure hit, Stimulus, uncertainty, fear, silver didn't crawl higher. It launched. From around $12, it raced above $30 in a very short window. And here's the pattern most people miss. Silver never breaks out slowly. Silver explodes when pressure reaches the tipping point. The breakout phases are violent. Candles get bigger. Pullbacks get shallow. And suddenly everyone is asking, why is silver moving so fast? But by then, the move is already underway. This is why history matters, because when you see silver stuck in a tight range with low volatility and low attention, that's not a warning sign. That's the setup. And every major silver rally in modern history has started the exact same way. Long silence, compressed volatility, then shock, physical demand versus paper price. Silver is being consumed at record levels by solar energy, electric vehicles, and advanced technology. And once that silver is used, it's gone forever. This isn't speculation demand. This is real metal disappearing into the global economy. Meanwhile, physical silver is getting harder to find in many parts of the world. Inventories are thinning, delivery times are stretching, and premiums are quietly rising behind the scenes. But here's the disconnect that should make investors uncomfortable. The paper price of silver barely reflects any of this real-world stress. Futures contracts and algorithmic trading still control the headline price, not actual availability. In other words, silver is priced as if supply is abundant when it isn't. History is very clear about what happens next. When physical reality collides with paper pricing, the adjustment is never gentle. This divergence doesn't resolve slowly or politely. It ends with silver repricing fast, violently, and without warning. Gold is leading. Silver always follows. Right now, gold isn't collapsing. It's stabilizing and quietly signaling strength. That kind of price behavior usually appears before the next major move, not after it. Historically, this is how precious metal cycles begin. Gold moves first, absorbs uncertainty, and establishes direction while most people aren't paying attention. Silver almost always lags in the early stages. It looks weak, underperforms, and convinces investors that nothing is happening. But then the script flips. Once gold's direction is confirmed, silver doesn't just follow, it accelerates. This is why silver is often called leverage on gold's move. When gold rises, silver tends to move faster, farther, and with far more emotion. Every major bull cycle tells the same story. Gold leads calmly, silver follows aggressively, and latecomers are left wondering how the move happened so fast. That's what makes this moment interesting. Gold is already hinting at strength, and silver is still being underestimated. And history suggests that gap doesn't stay open for long. Key levels to watch. Simple, not technical overload. Right now, silver is trapped between one clear ceiling and one clear floor. You don't need complicated indicators to understand what matters next. Price reaction at these two levels tells the whole story. The resistance level is where silver has been rejected multiple times. Each time price approaches this zone, sellers step in and momentum fades. But here's the important part. If silver breaks above this resistance and holds, momentum traders step in fast. Algorithms trigger, short sellers cover. And suddenly, silver isn't quiet anymore. On the other side is support, the level where buyers have consistently defended price. This is where confidence still exists beneath the surface. If silver loses this support, weak hands get shaken out. Fear spikes, stop losses hit, and impatient traders exit, often right before a reversal. This is how silver moves. First, it tests belief, then it punishes impatience. That's why these two levels matter more than any prediction. Silver doesn't need a forecast, it needs a decision. And whichever level breaks first will likely define the next major move. And this is the danger zone for most investors, because silver doesn't give you time to think once it decides. The move always starts quietly, and then it's already too late. If silver breaks higher, it won't send an invitation. Momentum traders will rush in, headlines will change overnight, and prices will gap before most people react. And if silver breaks lower, panic will do the cleanup. Weak hands get shaken out, confidence collapses, and fear peaks right where opportunity usually appears. This is why silver is so unforgiving. It punishes hesitation on both sides. By the time silver feels obvious, the easy money is gone. The breakout is already priced in. So this moment matters, not because silver is exciting, but because it isn't. When silver finally moves, it won't ask who's ready. It will simply move. And history says it's never subtle. Before we wrap up, one quick thing. This isn't a prediction, and it's not financial advice. Markets can move against expectations, and silver is especially volatile. The goal here isn't to tell you what to buy or sell. It's to help you understand the setup, the risks, and why this moment matters. Because informed decisions beat emotional ones, every time. And in a market like silver, patience and awareness matter more than hype.